All right, let's jump right in. Today, we're talking about something huge that's kind of hiding in plain sight in the world of finance: Sukuk. It's this massive market that's been quietly changing the game for asset-backed investments, and we're going to break down exactly what it is and how it works.
And when I say massive, I mean it. The total value of all the Sukuk out there is getting close to $1 trillion. Seriously, this isn't some tiny niche product. It's a major financial tool that governments and huge corporations all over the world are using. If you don't know about it, you're missing a giant piece of the global finance puzzle.
Okay, so $1 trillion. That brings up a really big question, right? When you buy a Sukuk, what is it that you're actually buying? Because, and this is the key, it is fundamentally different from a regular old bond. And that difference, well, it changes everything.
So here it is, the single most important thing to get. A Sukuk is about ownership, not a loan. Think about it. With a conventional bond, you're just a lender. You're handing over cash for an IOU. But with a Sukuk, you actually become a part owner in something real and tangible.
Okay, let's break this down because this chart makes it super clear. On the left, with Sukuk, you've got asset ownership. You share in the risks, but you also share in the rewards. Your return is tied to the profit or, yeah, even the loss of that asset. Now look at the right. A bond. It's just a debt claim. The issuer is on the hook for all the risk, and you just get your fixed interest payment no matter what happens. Totally different worlds.
And this quote really just nails it. You're not just lending money to a project, let's say an airport. No, you are buying a proportional stake in that airport's future revenue. Your success is literally tied to how well that airport does. You're in it together.
So, if it's all about ownership, how does that actually work? I mean, what does that look like in practice? It's not a one-size-fits-all kind of deal. There are actually a few different ways to structure it, and we're going to walk through the 3 main blueprints.
You know, the easiest way to think about these structures is to just imagine you're building a business partnership in 3 different ways. Each one has its own unique rules for who puts in the money, who brings the expertise, and how you split the profits.
First up, we've got Ijara. This one is lease-based, and honestly, it's the easiest to wrap your head around. It's simple. As investors, you all pool your money to buy a physical asset, like an office building. Then you lease that building out to a company that needs it. Your profit? It's just the rent they pay you. Plain and simple. You're basically a landlord. Next, there's Mudaraba. This is a profit-sharing model, and it's pure Shark Tank territory. Here's how it works. You, the investors, put up all the cash. The other partner, the issuer, brings the know-how and runs the project. If it all works out and there are profits, you share them based on a ratio you agreed on at the start. It's a classic silent partner setup.
And finally, Musharaka. This is the real deal, a true joint venture. Now, unlike Mudaraba, where only investors put up cash, here everybody contributes capital to the project, the issuer and the investors. Because everyone has financial skin in the game right from the beginning, you all share in the profits and the losses together. It's the most genuine form of partnership of the 3.
Okay, so these partnership models sound pretty cool, right? But, and there's always a but, the real-world market has its fair share of problems. Let's take a look at some of the roadblocks this trillion-dollar industry is actually up against.
The very first challenge is just scale. I mean, $180 billion in new Sukuk every year sounds like a ton of money until you put it next to the conventional bond market, which is in the trillions. It's not even close. It's a drop in the bucket. And that size difference creates a big problem: liquidity.
So what does that lack of liquidity mean for investors? Well, it leads to this number right here. This is what the industry calls a liquidity premium. Because Sukuk are harder to buy and sell quickly, investors demand a little extra return, somewhere between 15 and 50 basis points, as compensation for holding on to an asset that isn't as easy to offload.
And it's not just about how easy they are to sell. A few other big hurdles are holding things back. For one, there's no real standardization. A Sukuk from Malaysia might be structured totally differently than one from the Middle East. That makes pricing really complex, and it discourages the kind of active trading you need for a healthy market.
But here's where it gets really interesting. The market isn't just sitting around complaining about these problems, it's evolving, and its future is starting to merge with one of the biggest trends in all of finance right now: ESG. That's environmental, social, and governance investing.
I absolutely love this metaphor from the World Bank, the tofu hamburger effect. It's brilliant. The strategy is to take Sukuk, which is an unfamiliar product to a lot of people, that's the tofu, and wrap it in something that's super familiar and popular, like green and ESG investing. That's the hamburger bun. It makes the whole thing way more appealing to a global audience.
And you can see it's already working. Look at this. Green and sustainability-focused Sukuk are now about 10% of the entire market. They're basically building this incredible bridge between the core ideas of Islamic finance and that massive trillion-dollar universe of ESG investing.
So what's coming down the pipe? Well, that ESG trend is only going to get bigger. But the really exciting part is technology. People are looking at blockchain to bring some serious transparency to these deals. And then there's tokenization, turning Sukuk into digital assets. That could finally be the thing that cracks the liquidity problem, letting people trade tiny fractions of them 24/7.
And that really brings us to the big picture question, doesn't it? The whole idea behind Sukuk isn't just about finance rules. It's about a philosophy of sharing risk and sharing reward. It's a partnership model, not a lender-borrower model. And that makes you wonder, could this fundamental idea, this concept of shared ownership, actually be a blueprint for a more ethical and sustainable financial system for everybody? Definitely something to think about. Thanks for joining me on this explainer.